Hi, my name is Aman and I am a chartered professional accountant practicing in the Metro Vancouver region of British Columbia, Canada. In this video, I will talk about an interesting case law, Gagnon versus the King, which deals with the penalties associated with inadequate tax installment payments to the Canada Revenue Agency. In my previous video, I explained the workings and the system of the income tax installments. You should watch that video in case you want to understand how the tax installments are calculated. I've given the link on the top right of the screen. Coming back to the case. During the year 2019, the couple Paul and Maureen Gagnon paid quarterly tax installments against estimated income taxes owing to the balance due date, April 30, 2020. The Gagnon's holding company, JFP Holdings, declared a dividends of $300,000 each for Mr. and Mrs. Gagnon in the fourth quarter, that is from and after November 25th, 2019. You see, they paid the necessary installments in the fourth quarter based on the higher estimated income. However, the Canada Revenue Agency asserted that they under-remitted installments for the first three quarters, that is on March 15th, June and September 2019. So the CRA reassessed both of them for arrears interest and also imposed a penalty. The case went to the Tax Court of Canada. The Gagnon said that the reason for the payment for the lump sum dividend was that they feared that the Parliament would increase the tax rate on dividends in the following year. The court provided a two-part test for removing the penalty. The first test was that the taxpayer had probable reason to believe their income would be lower than the no calculation option, and the second test was the event leading to higher required installment was not foreseeable and impossible to discern before it occurred. Mr. Gagnon argued that the penalty should not apply because the dividend was unforeseen, so he could not be penalized for failing to include in his estimation. You see, Parliament did not alter the regime concerning Canadian dividend income on the date anticipated, and if it had, Mr. Gagnon would have been correct and his wager would have paid, and the arrears interest and penalty would likely be a small price to pay for the return. But that was all speculative, and so was Mr. Gagnon's predicted tax change. The taxpayer authored action born of prediction is not an unforeseen event, just an event which may never happen. The court found Mr. Gagnon was wrong in his prediction. So the court said that the taxpayer fell short on the second criteria since he was entirely in control of whether a dividend would be paid or not. For these reasons, the Gagnons lost the case and had to unfortunately pay the interest and penalty. You see, the tax authorities provide tools to help eligible corporations make their calculations more easily. However, depending on the situation, a company may need professional guidance from a chartered professional accountant to ensure that its tax affairs are always in order. If you want to be notified about our new tax videos, please consider subscribing to our YouTube channel. Thanks for watching and see you in my next video. Until then,